Regardless of what they do, the next thing they're going to do is cut rates. They're going back down to zero, but it's not going to stop the bear market, and it's not going to stop the recession.
Market, December 17th of last year, Euro-Pacific Capital CEO Peter Schiff, who was arguably the very first major Wall Street name to have predicted that the Federal Reserve would cut rates back then. Well, what do we see? It hasn't happened just yet, but Fed Chair Jerome Powell today signaled a rate cut.
We are closely monitoring the implications of these developments for the U.S. economic outlook, and, as always, we will act as appropriate to sustain the expansion with a strong labor market and inflation near our symmetric 2% objective.
Powell referring to the fallout from President Trump's trade actions against both China and Mexico. He obviously feels that that could potentially threaten what is a currently relatively robust U.S. economy. Here to weigh in and make his next bold prediction is Peter Schiff himself live in studio. Peter, let's just be clear. We haven't seen a rate cut yet. You predicted it was coming in December, that it will come soon. What are the odds that you say we will see a rate cut?
Well, I don't think that Powell would even open the door to the possibility of a rate cut if he wasn't prepared to walk through it. And in fact, the reason that I knew in December that that was their last hike and that the next move by the Fed would be a cut was because the stock market was falling in December, and the only way the Fed could stop the carnage was taking the rate hikes off the table. Well, now it's falling again, and so now all they've got left in their quiver is to actually cut rates.
I'm sorry, the market's falling again. Look at it today on the mere idea, Peter, that the Fed will cut rates. It's jumping.
Exactly, right? But, I think people are wrong if they think it's going to work again. The Fed was able to inflate an enormous bubble with QE 1, 2, and 3 and keeping rates at zero for as long as they did. But the next time it's not going to work. I think the bond market, one of the reasons the bond market has really rallied and yields have come down is because traders are anticipating that the Fed's going to cut rates in the next recession. They're right, but they're wrong on the outcome. We're going to have stagflation. It's inflation that's going to be the problem, and the economy is headed into recession, but the Fed should not be cutting rates because it's stoking the inflation fire.
Well, we don't have inflation right now, Peter. We are well below the 2% inflation rate that the Federal Reserve looks to as its sort of guide. But let's put this into perspective. How will people feel it, and how will the markets react if we cut rates? Because right now, at the mere sort of belief that it'll happen, the bulls are having a party.
Yeah, and, we're not way below it. We're barely below the 2% number. But that's just the way the government measures it. Of course, in reality, prices rise faster than what the CPI reveals. But I think what's going to happen is when the Fed goes back to zero, which is what they're going to do, they're not just going to cut 25, 50 basis points. They're going back to zero. But there's not a lot of room between where we are now and zero.
We're at 2.25 to 2.5.
So what the real stimulus is going to be is QE4, which is going to be bigger than the first 3 rounds combined.
Wait, is that your prediction?
Oh, yes.
You say, okay, articulate it here.
Well, the Fed's going to go back to QE. I mean, they're going to do whatever they can to try to stop the bear market and to try to prevent the recession. But they are going to fail. They're going to make it worse this time because Powell today came out and said that we shouldn't call this unconventional policy, that it's now business as usual to have quantitative easing and 0% interest rates. Well, the reason that we didn't have a dollar crisis the first time and the reason that inflation didn't take off was because everybody believed it was temporary, that it was an emergency measure, that the Fed was going to normalize interest rates, they were going to shrink their balance sheet. But when the markets realized what they should have realized from the beginning, that this is a permanent expansion of the balance sheet, this is debt monetization, that there is no end in sight, that it's going to be 0% forever, right? Then the bottom's going to drop out of the dollar, and then we're going to get all the inflation that we should have had, only more.
I know you well enough because we go back to high school. Yeah.
Yes, I was a teacher.
Yeah. That's kind of you. But let's just say, Peter, that you're a successful guy. So knowing what you believe is going to happen, where are you investing right now?
Well, I've been investing in the same place I've been investing. I've been preparing for this for a long time. So I am out of the U.S. dollar completely. I have foreign stocks. I have foreign bonds. I have a lot of gold stocks, which have, really been in a huge bear market for many, many years. But they're poised.
Gold is now above $1,300 per ounce.
Yes, but that's still very low. Remember, we got as high as $1,900 back in 2011 when people were actually worried about QE. Well, they were right to worry. The mistake was thinking that everything was okay. So when we go back to QE and 0% rates, gold's not stopping at 1,900. We're going to 5,000 to 10,000. But that means there's going to be tremendous gains in gold stocks. But I think the emerging markets, too, in particular, they have suffered with a strong dollar and the threat of a continuously rising dollar. Once the dollar starts to fall, that's going to provide tremendous relief for the emerging markets. And those stock markets are really going to take off as the U.S. market is in a bear market.
Let's bring you back when, if that happens.
Well, that will happen, but don't wait that long.
We will. Why? Is it going to be at least in our lifetime?
No, it's going to play out over the course of years, but you don't want to wait till it's all over to invite me back on. You got to, you got to have me on to do the play-by-play.
Yeah, see, he does smile, folks. He can be fun. Trust me. Peter, thank you very much.